right now.
Okay. I believe Jeff will continue to let people in as they join us, but I wanted to welcome everyone to our first tax law training session. This session, we do have plenty of space for more than 100 people to join us. So I apologize for the issue that we had last week with our Zoom, but we do at this point have that fixed. Just a couple of quick updates for you. The 4012s and test books have not yet been received. As soon as we receive them, we will notify you so that you can come and pick them up. The practice lab, we received notification today, that will be available Tuesday, November the 10th. The state and local pieces of that will not be available till sometime in January. So if you wanted to start working on your test, that would be something you'll be available to do starting next week. Quick housekeeping, just like last week, we will be muting everyone and we'll ask that any questions you have, you type into the chat, and we will be answering all of the questions that are related to VITA issues at the end of the session. So for those of you who are joining us for the first time, if you're not familiar with Zoom, there'll be a box you can click on that will have your chat, and then you would just type your chat in there, and then Jeff will be able to go through and read back all the questions for us to answer. And then just quickly, here's the agenda of what we'll be looking at today. We'll be starting off with Jared covering 2020 tax changes, things that are within the VITA scope. We'll be spending a lot of time talking about filing status and dependency. We'll be taking a short break. During that break, we'll be turning off our recording, and Jeff will be keeping time. He'll let us know when we get to about 4 minutes and 30 seconds so that you can start coming back to wherever you're viewing the session from. And then at 5 minutes, we will turn it back on. We're going to walk through a few example questions that are from the basic section of the certification test. We will then talk about some VITA best practices. And as we finish up with that, we will then start working with the questions and answers. This will be recorded, and we will be sharing this with you tomorrow if you'd like to listen to it again. So with that, I'm going to turn it over to Jared, and he will go ahead and start with the tax law 1.
All right, thank you very much, Michelle. I will go ahead and start sharing my screen here with us. And we'll go ahead and take a look here at our presentation for the new year. So one of the things we're going to be taking a look at first is to our presentation. A couple other things that I wanted to keep you informed of, just if you're relatively new to Zoom. We do have some features at the bottom that you can go ahead and give us some feedback, a thumbs up if everything's looking good audio and video wise, and just to be sure that we're getting you the best audio and video content we possibly can here. So just wanted to make sure that we can go ahead and take a look at our slides here. And how are we looking so far? All right, just want to be sure we're good to go. All right, thank you very much. I'm going to go ahead and turn off the video feature. Just unfortunately won't be able to see me, but just make the recording a little bit easier moving forward. So when you get the content moving forward, you'll be able to get a full video. Is not a file that's going to take you 20 minutes to download. So I'm going to go ahead and just stop my video for the time being. But, I will be with you here in spirit. So one of the things we're going to be taking a look at is going through some of the tax law changes. Since all of you have been here before, usually my speech starts off by saying nothing is new this year. Well, hey, guess what? This is a year that things have changed. We have a number of new developments here for 2020. In addition to the normal changes we have with the changes in standard deduction, there are a couple new tax law changes that will be impacting VITA. One of the first things, and probably one of the biggest questions we'll have moving into the 2020 filing season, will be the recovery rebates. Relatively interesting topic as it came up, hitting right around when the tax filing season occurred last year. These were advanced rebates sent to taxpayers in advance of this filing season. So what the government had used was the tax information from either their 2018 or 2019 tax return, whichever was the most recently filed. Now, if the individual received the maximum advanced rebate, there's really not much we need to do moving forward. We are going to be taking a look and seeing what information we get from the IRS in terms of how we can verify the amount of advanced rebate that they have received, just to be sure if there's any additional items that we need to cover. We'll talk about that a little bit as we get into the income section and as we get more information from the IRS heading into tax season. Now, one question that we may run into is if the individual has changed either their income or their status from 2018 or 2019, whichever year was used for the determination of the rebate, they do have the opportunity here to go ahead and actually get more. Or if they were ineligible for 19, let's just say, for example, they may have been a dependent on their parents' return, and in 2020, they are actually now not a dependent on a return, they would be eligible for that recovery rebate. So we'll be seeing a number of items moving forward here with the recovery rebate, and we'll talk a little bit more about that in the question and answer session, and also a couple more items throughout our course session for this fall season. Another item that we may see is the change in required minimum distribution. So these were actually suspended for the 2020 year. So anyone who had a required minimum distribution from a retirement account did not need to take one for the year 2020. So one of the things you may see, I'm not quite sure how much it's going to impact a lot of our VITA clients, but if there is no 1099-R for the current year, but there was one for 2019, it might be an item that we want to double check, just to be sure that might have been a required minimum distribution that they elected not to take for 2020. One other impact that is changing is that the required minimum distribution age has been increased from 70.5 to 72. That's only applicable for people who had not started the RMD process yet. So really looking at people born relatively 1950 is kind of the year we'd be looking at that would be mostly impacted by this change. Just simply means that they are not required to take a required minimum distribution for 2020. That's actually delayed until they actually turn 72. Speaking of retirement plans, there's another change that we saw with the tax legislation here during COVID, and that is the penalty for early withdrawal from a retirement plan has been waived. Now, this is going to be for purposes related to COVID matters only. So in order to have the early withdrawal penalty waived, there has to be a distribution related to COVID purposes. Typically, what would happen is the taxpayer would request a withdrawal from their retirement account. We're going to take a look and see how that coding will be coming on a 1099-R. Again, we'll cover 1099-Rs next week during our session on income. But there is a penalty if that withdrawal, penalty waiver, if that withdrawal was used for COVID-related purposes. And there's a whole litany of reasons why that can be exempt from the penalty itself. Also uniquely, we'll talk about a couple things next week about the repayment opportunities, that not all of it may be considered income for 2020. We might have the opportunity to spread that over a 3-year period and also repay monies back to the retirement plan, essentially using it like a interest-free loan. A couple things that did change on the deduction standpoint would be we now have 100% of AGI allowed for charitable contributions. In the past, that had been a 60% limitation. Again, probably not bumping into that a whole lot within VITA, but we now are eligible to take up to 100% of our adjusted gross income as a charitable deduction. What will be more applicable, I believe, for VITA is going to be the new $300 above the line deduction for non-itemizers. So what that means is we're actually going to have the opportunity for people who normally are going to take the standard deduction and take a new above the line deduction, effectively a deduction for AGI of $300. This is going to be in the same position that you may have taken other items like the educator expense or the student loan interest deduction. These are all above the line deductions. So this is going to be a new deduction opportunity for the 2020 year. In addition, those tax extenders that are in the front of your 4012, the ones that are typically the tuition and fee deduction, also items related to debt forgiveness on a personal residence, those have actually passed retroactively. So those are now back in the tax code and they are viable for 2020. So basically all the ones that we had seen earlier that we were waiting on legislature to extend, they finally got around to extending it, but well after the 2019 filing season. But those will be back into play. That includes residential energy credits and a couple other things like the tuition and fee deduction. Okay, so taking a look at the new tax law changes, we're going to cover these in a lot of detail as we move through the process. But we want to kind of get back in to talk about a few things that are going to be setting the stage for how we go about the filing. Fortunately, not many of these have changed. Now, this is a part where I get to go back and say, really, hey, not much has changed from what we've done before. Just want to show a couple things here, and I'll take away some of my annotation tools in a little bit. Is you'll notice in the upper corner, we actually have a reference. So on our slide here, you can see A1. That's referencing your 4012. That's actually going to be a reference item for a chart or a page in your 4012. So it just enables you as you take a look through the slide set where you have information here for that reference. So I'm just going to go ahead and hide that for us and make it a little bit easier so you can view the entire screen. What we're going to take a look at here is, again, taking a look at filing status requirements. A lot of questions you may have is, am I required to file a tax return? And this is actually one that we see quite frequently on the exams, on the certification tests. And so one of the things we're going to take a look at are, depending on your filing status, whether you're single, married filing jointly, married filing separately, head of household, or qualifying widow or widower with dependent child, which I just actually now told you what all 5 filing statuses are that we'll talk about in a minute. Once we determine the appropriate filing status, then we determine, do we have another opportunity? Depending on their age, we actually can see an increase in a standard deduction. So when we take a look at the columns, we're going to take a look at the filing status, their age, and then really this last column, this gross income column, is providing information on what the standard deduction would be based on that filing status and the taxpayer's age. One of the things we're going to take a look at for single individuals under the age of 65, if they have $12,400 or less of gross income, they would not be required to file. It's only once they exceed that amount. And what we're looking at here is the gross income is the exact amount of the standard deduction for the 2020 year. So you may notice these have jumped up a little bit from the prior year, just a couple $100 for these areas. But it is a bit of a change from what we had from before. So one of the things we're going to take a look at is moving along here with the gross income test. As you can see, as we get up in age, at age 65, you have a little bit more added to your standard deduction. Again, the very nice part about using tax programs to prepare returns rather than by pencil and paper is we don't need to do the calculations. Fortunately, TaxSlayer is very good at understanding the taxpayer age, and all we have to do is indicate the filing status and it will automatically populate our standard deduction. Same thing will happen as we notice the married filing jointly. Standard deduction is actually twice the amount of that of single. And the only slight difference is that you don't get quite as much of an increase as taxpayers are 65 or older. One detriment we have with the married filing separately, which we'll talk about again this evening when we talk about filing status, is that the gross income is only $5. Reason why is because if one spouse is filing itemized, the other spouse has to file itemized. With the tax rate minimum at 10%, it means if you have $5 of income, you owe $1 to the government, which is why that filing threshold is so low for married filing separately. A couple of the other higher areas that we'll see with our filing status would be the head of household. Again, the one that is very popular that people would like to get into, and we'll talk about the requirements for head of household. Just give you a reminder for what those are. You can see that those are actually substantially higher, a little over $6,250 higher than a single status for a standard deduction. qualifying widower with dependent child is actually at the same level as what the married filing jointly is. So that's actually our highest standard deduction for a single individual. And again, we'll talk about those as we go through. But if you want to reference this back again, the chart's coming from A1 of your 4012. The one nice thing I just want to refer to the 4012, as we change the process and how we're preparing returns this year, we have a lot more time to be able to look through certain issues. So I highly encourage you to review the 4012. Ironically, as we were preparing for this session, and we'll talk about this as we get to the examples, we actually here at VITA have gone through just to double check. We don't want to rely on our own memories for things because, one, we all get a little bit older and our memory gets duller. Second, tax laws change all the time. So we want to use the tax resources available to us. So we highly recommend that you keep a 4012 nearby just to confirm things like filing status, dependency rules, especially as we get into some credits and things like that. Now, outside of the people who have to file based on whether or not they meet the gross income and the standard deduction, people have to file if they have special taxes. So even if they fall beneath the filing thresholds, they must file return if any one of the following apply. So the top one we see here is net earnings from self-employment. It has to be equal or greater than $400. One area that we're seeing, particularly here with COVID, is a lot more opportunities for people to delve into self-employment, have a side job, side gig, side hustle, whatever you want to call it. That could be any areas from doing side work, handyman work, babysitting, driving for Uber or Lyft. These are all considered net earnings from self-employment. So if these amounts are greater than or equal to $400, they need to be reported. A particular note, and we'll talk a little bit more about Uber and Lyft when we get to income, is that their amount of income will be reported to them on a 1099. So we need to be sure that if a 1099 is coming in, that we are filing a return, even if they would have fallen beneath the filing status. Another area that we take a look at would be if a taxpayer received non-qualified distributions from a retirement plan. So these are where we take a look at the code 1 on a 1099-R. Again, we'll talk a lot more about that next week. And they owe tax on the distribution, which quite often happens. That is going to be a requirement that they have to file a return. Another one could be if they owe money related to the recapture of their first-time homebuyer credit, or there may be education credits that they have to repay, so they would have to file a return. Last one is actually our most important one, and I probably should have put that one first, but it stands out a little bit better here at the bottom of the slide in bold red, that if an individual has taken advanced premium credits to pay for health insurance they purchased through the marketplace, they must file a return. This year might be a little bit interesting with the health insurance through the marketplace, as people's income may have changed from when they made their determination in the late part of 2019. 2020 was certainly a much different year for people's income. So we may see a bit of a difference from what they anticipated to what they actually had earned. So it is critically important that we file a return for anyone who has advanced premium tax credits. So that will be part of the issue we'll take a look at there. Now, here's the fun part. Who should file? We just went through 2 different slides of who has to file, but generally what we want to take a look at is helping the people who need to file a return and who should file a return. So even if they didn't meet the gross income thresholds, the only way to get a refund from the IRS is to actually file a return. So if they had tax withheld through wages, if they had tax withheld through a retirement distribution, or if they paid tax during the year through an estimated payment or something along those lines, they have to file a tax return in order to get that refund. The government will not send them money automatically. Also, if they received a 1099-B, which is related to the sale of stocks or securities, or 1099-S, which is related to the sale of real estate, they should also be filing a return just to avoid getting a notice from the IRS that the IRS believes that they could owe more money. We just want to establish the fact that they have a basis in the property and how much gain or loss should have been reported on the return. In addition to getting your own money back through federal income tax withholding, the credit opportunities are really one of the really popular methods, and why VITA is so critical to our community about allowing people to come in and file to take advantage of these highly advantageous credits. So the earned income credit, which again is a refundable credit, the additional child tax credit, the refundable American Opportunity Credit. These are all ones that are coming back for purposes of even if you don't owe any tax, you can still get a refundable credit. Also, the eligibility for the recovery rebate credit, what we had just talked about before. They may be eligible now in 2020 when their prior year return may have indicated they weren't eligible. Now they may be actually eligible for that recovery rebate credit. So we want to file a return to take advantage of those. And also for state purposes, if you have a senior citizen coming in and they're eligible to receive the PA property tax or rent rebate, we can certainly prepare that for them and continue to do so, even with our change in VITA preparation. So just as a reminder, we do not have personal exemptions. They have been suspended from 2018 through 2025. The one thing that we do need to still determine is whether or not an individual can be claimed as a dependent on another person's return. So this is going to be very important in terms of determining who is getting credits, who can actually claim a dependent on a return. One of the things we see about rejections of returns is usually that a dependent has taken themselves on the return, they've claimed themselves on a return, and their parents go to file and the return's rejected because that dependent has already been claimed on another return. So it's just going to be important for us to go through the rules of dependency to make sure that we have these set up correctly. And that leads us into the whole discussion about dependents. And again, really no changes in terms of dependents. We just want to review the rules here for you. Again, referencing C1 of your 4012. The other thing we want to just remind you of with dependents, these do change each and every year. Just because they were dependent on a return in a prior year does not mean we just simply follow the prior year. We have to file each return on its own, and we just want to double check facts and circumstances to make sure that we are claiming the correct amount of dependents on a return. So one issue we have if a taxpayer is actually claimed on a return or could be claimed as a dependent by another taxpayer, they cannot claim any dependents themselves. So if they are either claimed on a return or could be claimed on a return as a dependent, they cannot take any dependents. And we'll go through a scenario after the break that will help explain the situation. In addition, in order to take a dependent on a return, the person that you are claiming has to be unmarried, or if they're married, they don't file a joint return, or there's another exception to the exception to say if they're married, they're only filing a joint return to get a refund. Usually not much of an issue here. Most dependents we're looking at here are going to be traditionally children. So those are the areas that we'd probably take a look at. They also have to be a U.S. citizen, a U.S. resident alien, or a U.S. national, or a resident of Canada or Mexico. So it's a fairly broad brush as to who can be claimed as a dependent. They just have to be a citizen, a resident, a national, or a resident of Canada or Mexico. And there are some special exceptions for adoption cases. So if we do get an adoption issue at VITA, certainly we can go ahead and consult our guides, talk to your site coordinator, and determine whether or not they've met the rules for claiming a dependent. One of the tests that we have to take a look at is, in order to claim a dependent, they have to either meet the qualifying child or the qualifying relative rules, and we'll go through each one of those. The first one we're going to be taking a look at is the qualifying child. This is the primary test. If an individual meets the qualifying child test, we do not move on to the qualifying relative. We always want to double check first to see if the individual will be a qualifying child. Now, the one thing I always love about the tax code is that we will change your knowledge of the English language. If I asked you what the definition of child was, you may have something in mind. Well, the government's going to tell you something else entirely what they believe a child is. So the first thing we're going to take a look at is what we call a relationship test. And we're going to start off with the definition to say the person that you're claiming as a dependent must be your taxpayer's child. Okay, that sounds pretty normal in terms of how we would think of that. Either your son or daughter. Okay, stepchild. We're still pretty good there. So if it's a child of your spouse, that makes sense. Now we're getting into the odd ones, the brother and sister. Technically not your own child, but they're related to you. We're going to talk about half brothers, half sisters, stepbrothers, stepsisters, or a descendant of any of them. So what we're effectively taking a look at is your family tree is going to go down from you. It's effectively going to be any of your descendants would count. So that would include your children, grandchildren, great-grandchildren. That would include going broadly to include your brothers and sisters and going down from them, including their descendants. So that could include your nieces and nephews in that aspect as well. That also applies for adopted children and eligible foster children. Now, the other issue we take a look at, in addition to the relationship test, we have an age test. So one of the age tests would be that they have to be younger than the taxpayer or spouse. Again, from rules of biology, it just seems kind of odd that you can have a child that is older than you. But really, this rule is applicable mainly for that test when we're taking a look at brothers and sisters. I don't believe this situation occurs all that often within VITA, but on occasion, if you have a household that does not have a parent living in the home and siblings are taking care of each other, and the oldest child is taking care of their younger brothers and sisters, they would be eligible to potentially claim them as dependents. They just have to meet the younger than the taxpayer rule. If you have a remarriage situation and you have a 50-year-old taxpayer and their spouse is 19 and their child is 23, that still counts. They just have to be younger than either the taxpayer or the spouse. There's an age test as well. So the age test for a qualifying child is they're under the age of 18. And just keep in mind, the tax code will bounce around a little bit between how they define age. In this case, what we're looking at is they have to be under the age of 19 at the end of the year. So it's basically 18 or younger is how we would take a look at that. So to be a qualifying child, you have to be under the age of 19, or you can be a full-time student under the age of 24. So what we're looking at for the definition of a full-time student is someone who's enrolled at least half-time at an institution, and that will all depend on the qualifying educational institution, whether or not they consider them to be at least half-time enrolled. And when we talk about full-time student, we're really talking about any part of 5 months out of the year. So it's really not a full-time student position. It's just really if you're enrolled at least half-time for at any parts of 5 months out of the year. So if we take a look at a graduating senior, typically they would be back on campus in January. We'll see how things go with COVID, but they would be on campus from January, February, March, April, and typically graduate in May. They would still be considered a full-time student because they were at least half-time enrolled for at least 5 months out of the year. It does not need to be full months, it's just any part of the month. One of the other areas that we can take a look at is outside the age test. They don't have to be younger than the taxpayer if they are totally and permanently disabled. So they can be any age if they meet the qualifications of totally and permanently disabled. The one nice part about the 4012, it does give some additional information as to what the total and permanent disability context means. It has to be a physician certification, and it has to be a limitation on their ability to earn a living outside of assistance. So in addition to the relationship test, in addition to the age test, we also have a test that they have to be living with the taxpayer for more than half the year. So they have to be with the taxpayer for more than half, not just half or part of the year. It has to be more than half the year. Now, the nice part about the more than half the year, any temporary absences don't count. So this would be along the lines if the dependent's off at college, if they are traveling, if they've taken a gap year or semester abroad and they're intending to come home, those temporary absences are not counted against the taxpayer. So any of those temporary absences will be considered as still living with the taxpayer. A couple other rules that we have. This one's important mainly for purposes of testing for VITA certification. We don't see this all that often, but for whatever reason, the IRS loves to test this on your definition of dependent, that they do not provide more than half of his or her own support. So what this means is that the individual, if they're earning money, so if you have a student who has a part-time job, we need to take a look to make sure that they did not provide more than half of his or her own support, meaning that they actually paid for things like their clothing, their food, those types of things, that at least more than half the support came from the person who's attempting to claim them as a dependent. If the individual had worked and they put money aside for savings, a college fund, or maybe they're just saving for their own rent or a down payment for a vehicle, that's not considered providing for their own support. That's just savings. So we don't often run into this situation within VITA, but it does occur on occasion. And we actually have a fact scenario coming up in our questions that's going to be somewhat relevant to this discussion. The other things that we have is you cannot file a joint return for the person. So your qualifying child cannot file a joint return. I would not imagine a lot of children are filing joint returns at this point. However, we may see a situation where someone may have gotten married, particularly if their spouse has recently joined the military. If they file a joint return, they're still allowed as long as they're only filing it to claim a refund. So again, we don't see that very often, but just one of those other little rules within the qualifying child. And we're also going to take a look at some qualifying child of another taxpayer. So if we have a situation where this definition is very broad, a lot of people could qualify because what we're looking at is effectively a relationship test, which is fairly broad, an age test, which if they're going to meet the younger than a taxpayer, they can meet the younger than taxpayer for most people. If we have multiple people living under one household, they are technically living with the taxpayer. We are not basing this test on who provided support. The critical test in qualifying child is just that the child did not provide more than half their support. So we may have a situation where we have a number of people who could technically qualify for claiming a qualifying child on their return. Now, the fortunate part for us is we actually have a qualified child tie-breaking rule system. So that's going to be a chart that we'll find on C2 of your 4012. So I just want to kind of go through this just to help you define who could possibly be a qualifying child. Usually this is a little bit different, I think, as we're not sitting in front of the client asking them questions, but instead may draw some questions out as we go through, taking a look at the return and the fact pattern. If more than one person's trying to claim the child as a qualifying child, and only one of those individuals is the child's parent, then the IRS, by definition, will default to the parent of the child. They get the tie-breaking rule over anyone else. Another interesting situation we have here is if both parents, and the IRS has to clearly say who do not file married filing jointly, which I always find humorous because if they're filing jointly, it would be on the same return, so we shouldn't even have an issue. But yet the IRS decided this is worthwhile enough to highlight that they're not filing jointly. So if both parents try and claim the child as a qualifying child, we sometimes run into this situation with divorced parents or maybe people who were not married. What we take a look at then is the person who has basically custody. Where did the child live for the majority of the year? Where did the child spend the greater portion of the year? That's the parent that gets to claim the child. And that's really where the IRS will come into if we run into a situation where more than one person tries to claim a child. Their first definition will be to determine where did the child spend more of their days. They will literally ask a question to find out how many nights the child spent with each parent. Whoever had the greatest amount of nights would actually win. In the rare circumstance that we would have an exact tie between the two parents, we would drop down to the third line here. So both parents, again, not filing jointly, claim their child and the child lived with them for the exact amount of time for each one. Then the IRS defaults to the person who has the highest adjusted gross income. So we go to the highest AGI. And that's a test that we're going to basically use moving forward. So once we kind of take a look at the parent with the highest AGI, the other tests are going to go through and determine who has the highest AGI. So if no parent can claim the child as a qualifying child, in an example here might be that you have a grandchild living with their grandparent, and the grandparent also has a child of theirs, the aunt or uncle of the grandchild with them. The individual has the highest AGI is going to win the tie-breaking rule. And the last situation is pretty similar here, is that if a parent could claim the child as a qualifying child, but they choose not to do so, then the individual has the highest AGI, gets to claim the child as long as your AGI is higher than the AGI of the parents, of the child's parents. Again, when we get down to the bottom of this chart, it gets a little bit more confusing. Usually, most of our situations are going to be relatively straightforward, but we do want to remind you of the child tie-breaking rules. So if we take a look a little bit further, kind of delving into the whole non-custodial parent issue, it is entirely possible for a non-custodial parent to claim a child. Now, when we take a look at the definition, we had to first say that the child had to live with the individual for more than half the year. Well, there may be situations where a non-custodial parent is granted the opportunity to claim the child. Usually it might be an agreement between the parents, or maybe it's in the divorce agreement. But we do have a whole section in your 4012 on C6 that will go through and determine how we go through non-custodial parents. As a reminder, why is it important for the qualifying child rules? Well, you are eligible for 6 tax benefits if you can claim a qualifying child. You can take the credit for other dependents, the child tax credit. Both of those are relatively similar. We could take a look at head of household status, earned income credit, credit for child and dependent care expenses, and also an exclusion from income for dependent care benefits. This is found on box 10 of the W-2. This is going to be an opportunity as we enter the W-2 into TaxSlayer that'll automatically calculate whether or not those benefits would be excluded. So those are the primary benefits you get for claiming a qualifying child. Now, what do we do in the case of a non-custodial parent? So typically, the IRS, again, if we take a look at the default rules, they will go by rule to the individual who had the child for the majority of the year. So in order to get out of that presumption, we have to have a signed Form 8332, which is basically the custodial parent granting release of dependency exemption to the non-custodial parent. Usually this arises more in divorce situations, and hopefully we don't run into many of those within VITA, but typically you would want that Form 8332 signed during the divorce proceedings to make it a lot easier and just attached to the return. The signed Form 8332 will trump the other rules. It will go ahead and override any of those other tie-breaking rules. If not, if you don't have the signed 8332, then the IRS automatically defaults back to the where the child spent the majority of the year. They will not take a look at the divorce decree. It doesn't matter. Unless that divorce decree was issued before 2008. At this point, most of the child, we're running out of years on the divorce decrees before 2008 for the custodial parent status. Now, if a non-custodial parent claims a dependent, they are still eligible to take the child tax credit and the education benefits. So these would be the child tax credit on the return and the American Opportunity Credit, or taking a look at tuition and fees, or the lifetime learning credit. The custodial parent, where the child still spent the majority of the year, is still eligible for a number of very important tax benefits. So even if they waive their right for the child to be claimed for child tax credit, the custodial parent is still eligible for a number of different items. So that could include the earned income credit, the child and dependent care credit, and exclusion from income for these benefits, and also head of household status. So even though the individual is not claiming the child as a dependent on the return, the fact that they have custody would still make them eligible for these important benefits: EIC, the child and dependent care credit, and head of household status. Okay, so we're going to move on now to our next area, and that would be our rules for qualifying relatives. So this is going to be on C4 of your 4012. And again, as we mentioned, that the qualifying child test will take precedent. That's going to come first. So the first rule we have is that the person must not be the taxpayer or anyone else's qualifying child. If they meet the qualifying child test, that's where it stops. We don't have to look any further. Now, the qualifying relative rule is a little bit different. It changes a bit from the qualifying child rules. Now, one of the interesting parts is the first definition we have is that you don't even need to be a relative of the taxpayer, as long as you live with them all year as a member of the household. but this literally means all year, from January 1 to December 31. So if you have a child living with you and they have a friend that decided to move in and you decided to keep the friend in your household, they could potentially be a qualifying relative. So that is the first kind of unique opportunity we see here with qualifying relative. They don't even need to be related to the taxpayer. Now, they could also meet the rules here for the relation. And again, what we're looking at is kind of starting off the same way as a qualifying child. We're looking at child, stepchild, eligible foster child, grandchild, great-grandchild, brother, sister, half-brother, half-sister, stepbrother, stepsister. So these are the same ones we've been looking at before. We're also going to add not just your lineage going down in direct descendant. We're looking at going across to your brothers and sisters, but now we're looking at your parents as well. So now we're going up in your direct ancestors. So you can actually treat your mother or your father or your grandparent or other direct ancestors, unfortunately not foster parents, but stepfathers, stepmothers count. We also can take a look at their relatives. So your aunts and uncles count as well. Your nieces and nephews count. Your actually in-laws count as well. So if you're married into family, that counts as well. So brother-in-law, sister-in-law, father-in-law, mother-in-law, son-in-law, daughter-in-law. The only one that doesn't count are cousins. So while the IRS threw a fairly broad definition out here in terms of qualifying relative, the one that never fits into this definition is a cousin. They do not fit into a qualifying relative status. So I'm not quite sure where they came up with their definition. Obviously, it's different from your DNA testing and your ancestry.coms, because those family trees will include everybody. But just for qualifying relatives, cousins do not count. Now, the other area, before we get real excited about trying to take a look and see who all we can count as dependents, we just want to be very cognizant of this next rule, and that is the gross income test. So the gross income for the person you're trying to claim as a qualifying relative has to be less than $4,300. So this is usually what's going to kick out most of the opportunities to take a child who might be living with you, particularly an adult child. They no longer meet the qualifying child rules because they might be the age of 26. But if they have income more than $4,300, they are not eligible as a qualifying relative. So that's one of the areas that we probably should look at first, just to determine how much income does that qualifying relative have. The other change that we have is that the taxpayer now must provide more than half the person's total support. For the qualifying child rules, we didn't care who provided the support, as long as the child did not provide more than half their support. In this case, the taxpayer themselves must provide more than half the support. So what it's going to mean is only one person should be eligible to claim a qualifying relative. So those are the overview of the dependency rules. Really nothing's changed. I just wanted to provide a bit of a reminder for you here of how those will play out, just so we can go ahead and take a look and see. Remember, each year will stand on its own for dependency. So as children age, as situations change over time, we want to be sure we're claiming the correct amount of dependents. And fortunately, our 4012 guides are very handy to go through and help determine what that filing status, or I'm sorry, the dependency opportunities would be. Getting a little ahead of myself here, and now talking about filing status already. So filing status is going to be our next area we'd like to go into. Again, similar to dependency, this can change over time. The best part we have, again, is just reminding you in the 4012 on pages B8 and B9 of your 4012 will give you some additional definitions, including some very nice flow charts to help determine the appropriate filing status. We didn't add any new ones this year, nothing came out. So these definitions are pretty much the same as what we've seen before. And we'll talk about them in order. We're going to talk about single. We're going to talk about what happens with married individuals. We'll talk about the special one that everyone would like to try and get into, that head of household. And we're also going to talk about our qualifying widow or widower with a dependent child. One of the more rare of these opportunities, but yet we want to talk about that anyway. So let's start off with the single definition. So this is taking a look as of the last day of the year. So literally December 31st, we want to take a look at what your filing status is. If you are not married, doesn't matter if you're engaged, if you're intending to be married, if you are not married, you are considered single. Same way if you're legally separated from your spouse under a divorce or separate maintenance degree, you could be considered single. So if you're legally separated under a divorce decree, you are considered single. One other area that we sometimes run into when people fill out their intake sheet, they may indicate that they are married. And when we take a look a little further, they indicate that their spouse is deceased. And if their spouse died before 2020, so unless your spouse died in the current year, they will not be considered married. So they will be considered a widow if their spouse died before 2020. They would be considered single unless they meet another test, either a qualifying widower or had a household status potentially. So even if they were married and their spouse had passed away, unless it was in the current year, they will typically be single. Single, fortunately, is one of our the basic starting point. Hopefully, most people know if they're married or not married. It's usually a pretty easy question to find out. You don't accidentally get married that you're not aware of. And again, we take a look at your status as of the last day of the year. Now, if you are married on the last day of the year, you may file jointly, even if you're married and living apart. If you're married and living together, absolutely, you can file jointly. If you're married and living apart and you're not yet legally separated or divorced, you can still file jointly. Even if you're separated under a temporary decree, you can still file jointly. Or if you're in a common law marriage, you can file jointly. So as long as you are married as of the end of the year, you can file jointly. Another important part, if your spouse died in the current year, if your spouse died in 2020 and you did not remarry, then the survivor can actually file jointly as long as one of the tests are met. Basically, if they were still married by the end of, if the surviving spouse did not remarry by the end of the year and the spouse died in 2020, you can still file a joint return with your deceased spouse. Now, a couple other reminders here. Same-sex marriages are now recognized in every jurisdiction here in the U.S. So if they are married together, we can file a joint return. As a reminder, it only applies to recognized marriages, any type of registered domestic partnership, civil unions, or other relationship do not count. That also applies to opposite sex couples. You have to go through a marriage ceremony to be recognized. A civil union does not count for married status. So most times when we have a married individual, the filing status will be married filing jointly. Every once in a while, we may have a situation where someone wants to file separately. If you are married at the end of the year, you do have the option to file separately. We generally do not recommend doing that. However, there are some reasons why people may want to do that. They may want to avoid joint liability. If you sign a return with the spouse, you are both responsible for any tax owed or any tax adjustments moving forward. So that could change people's ability to want to file with a spouse. If someone does have that situation, we do have some ability. We have both an injured spouse form. Sometimes what happens is your spouse may owe money to the IRS, whether it's back taxes or child support or student loan issues. You may actually file what we call an injured spouse form. You can file a joint return, and inside TaxSlayer, that will go ahead and split the refund between both parties. So you can still file jointly, still get the benefits of filing together, but you can separate your liability so your refund will not be taken from the IRS to fulfill a spouse's obligation. So that would be an injured spouse provision. Also, if you are leaving, there could be some issues with your spouse that you don't quite trust them. There is also an innocent spouse provision. We don't really work with it too much within VITA, but we do have resources to be able to go ahead and refer people outside to our Mid-Penn Legal Center and other resources that they can apply for an innocent spouse relief. As long as they weren't aware or had knowledge that there was some sort of fraud going on, generally the IRS will grant relief under an innocent spouse provision, that they will not be held liable for their other spouse's fraud. Now, there have to be following a number of circumstances. They have to truly be unaware that there was something not reported correctly. If you're signing a return and your spouse works every day and they only report that they had $500 of income from self-employment, but yet you're able to make monthly mortgage payments, you're able to take vacations, you know that you have excess cash, you're probably not innocent at that point. But just another position to take a look at. In very limited circumstances, you may pay less in tax. That's generally when we have a very high income earning taxpayer and the spouse does not really have much income. It may make sense to file separately, but we don't usually see that. It doesn't happen very often, and particularly in VITA with the tax brackets the way they are, we rarely see this be beneficial. Usually we're going to see these other items, which is really the negative effects of married filing separately. So if you file separately, you're going to lose a number of these very beneficial credits that we've talked about, or they may be significantly limited. Those include things like the earned income credit, the credit for the elderly, which is automatically calculated, the child care credit, the adoption credit, and the education credits. These are all incredibly powerful credits that are no longer eligible if you are filing separately. Other issues can be lost education benefits, including the student loan interest, the tuition fee deduction, and the ability to exclude savings bond interest from your tax return. Other things can be, if mentioned before, if one spouse itemizes their deductions, then the other spouse must also itemize. So if one taxpayer is living in a home and deducts mortgage interest, real estate taxes, and other itemized deductions, and the other spouse is living in a rental apartment, they also have to itemize, even if they do not have any itemized deductions, or even if those itemized deductions are not greater than the standard deduction. They no longer get the standard deduction. If they have Social Security, a greater percentage of Social Security's tax goes almost immediately up to 85%. There are also some other issues we run into about home sale exclusion changes, some capital loss deductions that we don't get any longer, and some differences in IRA deductions and contributions. So married filing separately is probably the worst scenario we would take a look at. So we really want to have taxpayers understand the situation they're getting themselves into. Now, one area that taxpayers normally like to try and get to is the head of household filing status. Now, this is incredibly popular. People love to be called head of household. They may have heard from friends that they get a higher refund based on head of household. So we just want to be sure we fully understand the rules of head of household. And again, those are going to be explained in B10 of your 4012. What we're going to take a look at is to qualify, a taxpayer must meet all of these tests. So we actually have 4 tests here. And I'll go into the fourth one a little bit in more detail. One is that you have to be a U.S. citizen or resident for the entire year. One thing we do have in the Lancaster County VITA program, we do have a number of refugees coming to the U.S. If they're not a U.S. citizen or resident for the entire year, they are not eligible for head of household status. One other thing we take a look at is either you're not married at the end of the year, meaning that you would normally be filing a single status, or you are considered unmarried, and I'll get into more detail on the considered unmarried in a minute. You have to pay more than 50% of the cost of maintaining a home, keeping it up, and the home has to be a principal residence, meaning for more than half the year for either a qualifying child, and we'll take a look at some of these exceptions, or a qualifying relative. And the nice part is when we take a look at these within the chart, if you go through the flow charts in the 4012, it's pretty clear of how these would work. And we do have some exceptions for parents. Now, what does a head of household mean for the considered unmarried? Well, what we're looking at is we're filing a separate return. So in order to be considered unmarried, you would normally be filing a married filing separate return. So you're going to be filing separately. The taxpayer has to pay more than 50% of the cost to keep you up the home for the tax year. The spouse did not live in that home during the last 6 months of the year. So this is a critical element. So what we're looking at is the last 6 months of the year, effectively from July 1st through the end of the year, the spouses did not live in the home. The taxpayer's home has to be the main home for more than half the year for the child, stepchild, adopted, or foster child. Very important to note that a grandchild will not put you into unmarried status. So a grandchild does not qualify for the considered unmarried piece. So what we're looking at here is the child has to be a dependent of yours. Again, we're looking at that opportunity to say that they would normally be a dependent and they have to live with you for more than half the year. But we mentioned again, if you release the dependency exemption to the non-custodial parent, you can still qualify as being considered unmarried because the child did live with you for more than half the year. So if that's a situation while they're not on the return, you simply release them to the non-custodial parent, you may still be considered unmarried and still file head of household. A couple other rules we want to take a look at for the cost of keeping up a home. So we have a chart here in B11. This is actually the same thing the government will use to go back and determine who has provided more than half the cost of keeping up a home. That includes the property cost. That's the mortgage interest expense. That's property taxes. That would be rent on the property, utilities, any of your repairs, maintenance, any of your insurance, any of your household expenses. That's also food consumed inside the home. So we're looking at groceries. We're taking a look at meals eaten in the home. I think during COVID, when we have a lot of takeout and delivery services, we may see a lot more food consumed in the home rather than outside the home. But we're looking at what was actually part of the home itself. With our nice little clip art in the bottom of the slide here, we can see we're literally looking at anything on the property or inside the walls. The cost of keeping up a home does not include personal expenses. So it does not include what we would consider some elements of support, meaning clothing, education, medical expenses, any vacations or transportation. So cars don't count. Life insurance doesn't count. So we're literally looking at the four walls of the home. What does it take to pay for the property, to maintain it, to insure it? What are the costs inside of it? Utilities and other household expenses, including food. So the B11 on your 4012 will give you a chart very much like this that the IRS would use. And they would simply go through and say, let's go ahead and add up all these items. We have column B here, which is the amount that you've paid. We have the total cost, which is the total amount for the year, irrespective of who paid it. And we'll take a look at the bottom. If your column amount you paid is more than 50% of the total, then you are considered of more than 50% of the cost of keeping up a home. So it's a fairly straightforward definition of how we would look at taking a look at the cost of keeping up a home. The last status I want to take a look at is a qualifying widow or widower. And just as an important note, this also has to include a qualifying child as well. So all of the following must be met. So the taxpayer's spouse died in the prior 2 years. So we're not looking at the current year. We have to look at the prior two. So we're looking at 2018 or 2019. The taxpayer was entitled to file a joint return in the year the spouse had died. The taxpayer did not yet remarry before January 1st of 2021. The taxpayer paid more than 50% of the cost of keeping up his or her home, and the taxpayer home was the main home for the entire year. So what's changing here is it's the entire year, not more than half. It has to be the entire year for the taxpayer's dependent child or stepchild. So grandchildren are not included in here, nor are foster children. So the qualifying widower test is generally in a situation where you have a spouse who died relatively unexpectedly that still has young children at home. And I am actually going to run into the situation not for the current year, but an individual I work with had unfortunately passed away in a farming accident. And has left his wife and 8 children back home. For the 2020 year, we would file that return as a joint return because he died in 2020. For the next 2 years, as long as she does not remarry and she keeps up home for the entire year for her dependent children, and she paid more than half the cost of doing that and did not remarry, she would be entitled to this qualifying widow filing status. And again, the benefit here is that you're getting the full standard deduction as a married filing jointly. Okay, so I want to talk about just a couple unique filing situations. We've actually moved this up into our filing status and dependency just because we want to make sure we're all on the same page when it talks about resident versus non-resident aliens. So we'll talk a little bit more about where these are located. They're a little bit further down in your 4012. Usually what we're going to take a look at are some of the rules that help determine what your filing status would be. We also get to use the dependency rules as we talk about the resident versus non-resident alien. As a reminder, if we have taxpayers in the US and they're on a visa with an F, a J, an M, or a Q, they are outside the scope of VITA. And with the way our preparation is working now, they should not even get past the initial intake piece. So hopefully you don't run into those situations. But if anyone's on a basically a student or a teaching visa or temporary visa, they would be considered a non-resident and would not be within scope. If we have a resident alien, they are going to be treated similarly to US citizens. So if you're here as a resident alien, you will still be getting the full benefit of the filing status and the dependency rules as a US citizen would. You are also, like a US citizen, taxed on worldwide income. So if you still have issues with receiving income from your home country, you would be taxed on that here in the US. One area to be cautious of is maintaining a bank account in a foreign country. Technically, that would need to be reported on the with the return as well. That there are some questions that we have to answer to determine whether or not they have access to foreign bank accounts. So if they're a resident alien, we can certainly work with them here within VITA. If they are a non-resident alien, they would typically file a Form 1040-NR. These would be things like refugees, students, teachers, some other undocumented immigrants. These are outside of scope for VITA. So we will not be preparing any 1040-NRs. What we're looking at here is effectively individuals who meet the resident alien test, and we'll take a quick look at what those rules are here in just a minute. So here's where we actually get to the information in your 4012. If you are working with these individuals, it's going to be on L1 of your 4012. The big one we take a look at is really the green card test. So the green card is that they have certified with the US that they are lawful permanent residents. They have a valid alien registration card. Probably no surprise, it's no longer green in color. So at one time it was green, it's no longer green. It is simply a valid alien registration card. If your taxpayer has one of these cards, they are considered a lawful permanent resident. They are a resident alien, and they would meet the green card test. Now, another way that they could actually meet the resident alien test is if they meet the substantial presence test. So this is actually based on the number of days and years that an individual is physically present here in the US. And we do have the chart available in the Pub 4012. Again, it's on L1. What we're going to do is we're going to count the number of days that they're here in the US for the current tax year and the prior 2 years. And fortunately, the L1 goes through a very nice example of how we would go ahead and do that. Now, the only way that we can do that here within VITA is if they are not in their first year in the US. It has to be second or longer year that they've been here in the US. We don't have the capability to go ahead and do the test on a first year resident alien. So unless they have a green card, then we are not eligible to do their returns. A quick note about tax identification numbers. Most of the individuals coming in to have their tax return prepared will have the Social Security number. So that is actually issued by the government, and we would get a Social Security card. They may also have individuals that don't have a Social Security number yet may have an ITIN. So usually they're in the process of getting a Social Security number. That's an individual tax identification number. Or if they're in the process of an adoption, they may get an ATIN, which is an adoption tax identification number. The one reason we want to bring this up is in case we do have an individual with an ITIN. Usually what may happen is they've been given a card from the government that says, here's your temporary identification number, but they may have a W-2 with a different Social Security number. So it may not be the exact one that they're using for the ITIN. If that's the case, what we're going to do is we're going to use the ITIN on the 1040, and we simply enter the W-2 information exactly as it's shown. So whatever Social Security number shown on the W-2, we enter that into TaxSlayer. If the individual has an I-10 with a different Social Security number on the W-2, they are not eligible for the Earned Income Credit. Also, if you have a dependent with an I-10, they're not eligible for the Child Tax Credit. They have to have a Social Security number in order to be eligible. So one of the things we take a look at as we move through is just identifying some of those activities. We're going to go ahead and take a 5-minute break here. I believe we'll go ahead and put on a timer in just a second, and we will come back after and do a little bit of wrap up with a couple examples. And Michelle has a couple more frequently asked questions and tips within VITA. We'll go ahead and take a 5-minute break here and come back and finish up our program.
Okay, welcome back, everyone. What we're going to do now is get started talking about some of the questions. These should be in the decks that I had sent out to everyone so that if you had a chance to read through it, you can see if your answers were correct. If not, you can have a chance to work through this with us as we do it. All right, Jared, let me see if I have you. I had turned you off. Let me see if you're turned back on now.
Okay, I think I'm back on. If everyone can hear me all right.
Can hear you very good. So go ahead, turn it over to you.
Okay, fantastic. All right. Did you want to go through and move the slides, Michelle, or do you want me to hop back in there?
I can go through and move these since there's just 4 of them.
Perfect. All right. Let's go ahead and take a look at the first scenario here. Okay, so question number 1 that we'd be looking at would be dealing with a couple, Aiden and Sophia. They are married and they've always been married filing jointly. Aiden died this year, May 5th, 2020, at the age of 58. Sophia, age 56, is not remarried. Aiden has earned $5,000 in wages and Sophia has earned $51,000 in wages. Sophia paid all the costs of keeping up a home and provided all the support for their 2 children, Maya and Oliver, who live with them all year. Maya happens to be 11 and Oliver is 15. Sophia does not have enough deductions to itemize, but she did make a $500 cash charitable contribution to qualified charitable organization in the year 2020. Aiden, Sophia, Maya, and Oliver are all U.S. citizens with valid Social Security numbers. So the question that we'd have here is, which would be the following appropriate status for the 2020 year? Okay, it looks like our slide is still stuck on the coffee. I will, Michelle, are you able to advance that? Okay, and I'll tell you what, I will actually go over and take over for Michelle here.
Can you see it? Is it visible now?
Do you have the coffee mug? Be able to advance the slide to the next one?
I'm not seeing that, Jared. Why don't you go ahead and take control?
I will go ahead and take over. All right.
Thank you.
Here we go. I will now share the screen here with you guys. Okay, and now are we off of the coffee mug? All right. Perfect. So what we want to take a look at here is what would be the appropriate filing status for Sophia in this case. And if you're leaning toward the married filing jointly, that would be the most appropriate status. The single, we don't need to file single because she still meets the definition of married filing jointly. I'm going to skip over head of household for a second, but qualifying widower does not apply because the taxpayer died in the current year. Qualifying widow or widower would only apply if he had died in 2018 or 2019. So the most appropriate filing status would be married filing jointly. There could be an argument that you could try and do an end around to get into head of household status. but relatively complex because you would have to have Aiden file separately. Sophia to be considered unmarried, but the benefit would not be there. You would not actually have a benefit for filing. So the most advantageous filing status would be married filing jointly. Okay, so we'll move on to question number 2. Again, a little bit more involved. What we're going to see here is we have Tamara, who is 52 years old. Her divorce decree became final on September 20th, 2014, and she has not made any modifications. What we're basically looking at that one is that she is paying alimony of $500 a month to her ex-husband, so she paid him a total of $6,000. She does pay all the costs of keeping up her home here in the United States. She earned $40,500 in wages, which is her only income. She has a daughter, Kimberly, who lived with her all year. She is single. She earned $8,000 in wages. Kimberly's son, Christian, who was born on December 2nd, 2020, and Christian lived in Tamara's home all year as well. Tamara provides more than half the support for both Kimberly and Christian. Tamara, Kimberly, and Christian are all U.S. citizens with valid Social Security numbers. So again, taking a look at the filing status allowable for Tamara, what we would generally do is consult with the 4012 and determine which one would be applicable here. So I'll give you a moment to take a look at that. I see a couple of you are responding in chat, which is great to see here. And all right, Mrs. Navarro, head of household, correct answer. So that's what we'd be looking at here. We'd be looking at a head of household status, because what we're doing is we have a single individual who would normally be filing singly. Because she meets the qualifying rules, she has a qualifying child here. In fact, she technically has 2 qualifying children. It provides more than half the cost of keeping up the home, and they live with her for at least half the year. She can be considered head of household. Now, this is going to jump ahead a little bit because we haven't talked about the earned income credit before, but we're going to kind of jump into that a little bit here with a couple of these questions. So for the second part of slide question number 2 here, which ones of the following can be considered qualifying children or for the earned income credit? So answer A would be none. Answer B would be Christian but not Kimberly. C would be Kimberly but not Christian, or D would be both. All right, as I tell my students in class, there are no, you're not getting graded tonight, so you'll actually be in pretty good shape. Now, the interesting part about this one is that both would be considered qualifying children for the earned income credit. Now, what we would do is we drop down in the 4012 and take a look at the rules for the earned income credit itself. But because they're both considered qualifying children for purpose of dependency, they still meet the rules. They would both be considered qualifying children for the earned income credit, which essentially would allow her to have a slightly better benefit in terms of the earned income credit calculation. Okay, we'll move over to question number 3. Here we have Sandra Clark, 45 years old. Sandra Clark's a clerk, great play on words there, and earned $27,500 in 2020. She has a daughter, Debbie, who's 26 and is not disabled. Debbie lived with Sandra as a member of her household for all of 2020. Debbie works as a receptionist and earned $18,250 in 2020. Sandra comes and would like to claim Debbie as a qualifying relative on her 2020 return. What would our response be? So we have an option to say yes, absolutely, because Sandra, you probably let her live with you all year and you provided more than half her support, or B, the answer would be no. Okay, and looks like we're getting a number of no's here. And that's the correct response because Debbie had gross income of greater than $4,300 during the tax year and would not meet the definition of a qualifying relative. Okay, and a question in the chat here about question 2. I'm going to pop back to that for just a second here. So because Tamara's going to claim both as dependents, it means Kimberly cannot claim her son. So that is a correct response. When we take a look at the definition of being able to claim a dependent, the only way that you can claim a dependent is that you yourself cannot be claimed as a dependent on someone else's return. So in this case, based on the tax rules, Kimberly actually cannot claim any dependents. So she cannot claim a dependent because she herself has the ability to be claimed as a dependent. Now, technically the rule says that if they could be claimed as a dependent. So when we take a look at these definitions here, Tamara could claim Kimberly as a dependent, which means Kimberly not eligible to take any dependents herself. So all the people in that situation would be considered dependents of Tamara. So Kimberly would not be eligible to take a dependency exemption for her own son. And quite honestly, in this case, it probably would not help her because what we'd be looking at there is she would not have, she'd wipe out her entire earnings through her standard deduction anyway. So unless she got a refundable credit, it would not provide any benefit to her. Now, question number 4 is a bit unique, and just want to let you know these are coming directly out of the test booklets for the certification exams. So bear in mind that these are not necessarily situations that we're going to see here within VITA necessarily, although what we have here in this scenario is we have an individual who is single, earns $28,000 as a cashier, her only income. She has a son, Tony, who's 17, full-time student in high school. Tony received Social Security survivor benefits of $5,000 in 2020. Generally not a problem with that. None of the benefits were taxable. He also earned $10,000 during the summer working as a website developer. Tony had no withholding on box 2 of his W-2. Again, he's underneath the filing threshold for the standard deduction, so he would not owe any taxes. However, he used his Social Security survivor benefits and his wages to provide over half his support. Gail and Tony lived together for all of 2020 and are U.S. citizens with valid Social Security numbers. What would be the most advantageous filing status for Gail for 2020? So one of the criteria we take a look at here is she's unmarried. So that would normally default her to single. So we'll make it a little bit easy. We'll take answers B and C off the table for you here because she's not married. But let's take a look at the opportunity. Could she possibly claim head of household status? Okay, I'm taking a look at the chat. In this case, she actually cannot take head of household status. Because her son, who's 17, would be a qualifying child. We have to stay in the qualifying child rules. So because he's 17 years of age, he provides more than half his own support. He is not considered a dependent. So for those purposes, he would not be a dependent for purposes of the dependency, and therefore cannot be considered a qualifying child for purposes of head of household. So for Gail, she would only be able to file as a single individual. So the response that she cannot because he provided more than half his income would be correct for purposes here of a filing status. So the filing status for Gail would be single. Now, we do have another opportunity for Gail. So the one thing we want to take a look at here, and again, we'll take a look at credits a little bit later on, I think in 2 weeks. So what we want to take a look at here for earned income possibilities. What we review here for Gail, can she claim Tony on her return as a qualifying child for the earned income credit? Again, we didn't take a look at this yet, but here's why we would go ahead and review the 4012. And in fact, as I mentioned, when we were preparing for this session, we actually went through as a group just to help determine the correct response. And what do we think about the qualifying child for the earned income credit? Now, this might be pushing a little bit because we didn't talk about that tonight, but the answer is actually true. Because the interesting part about the qualifying child for the earned income credit is we no longer have the position here where we have a support test. So the support test does not apply for the qualifying child for dependent for earned income credit purposes. So she can actually take Tony on her return as a dependent, which would allow her to take a higher amount of earned income credit. Okay. So good job on these answers. And just one, oh, sorry, go ahead, Michelle.
Did you see the question in the chat about if he would have spent his household, spent his earnings not on support, then Gail could have been head of household? They're asking if that's correct.
That is correct. If the money was not spent for his own support, if he saved that money, that would actually allow her to take head of household at that point in time. And I just want to go back to another question that we had a little bit earlier, dealing with Tamara and the 18-year-old. So the issue is because Kimberly could be claimed as a dependent, she could not claim her son. And a follow-up question would be, what if the 18-year-old was not living with her mother? Could she claim a dependent? And absolutely she could, as long as she would not be claimed as a dependent or could be claimed as a dependent on someone else's return. So generally an 18-year-old with her own child would be out of the house and would not be meeting the definition of a qualifying child. So that would entitle them to claim a dependency exemption. Okay, and I think what we'll do here, if you want me, Michelle, I will stop sharing and let you take over for the next series of questions as we go through, and then I'll pop back in for our Q&A session at the end of tonight.
That sounds perfect. All right. Can you see my screen, Helpful Client Tactics? All right, can you just pull the chat up here real quickly to.
Yes, we can see it, Michelle.
Okay, thank you very much, Jeff. All righty, so as we've talked before, this year is going to be a little bit different. The intake that we're going to do with clients in most cases will not be done in person. It will be done over the phone. So just like with an in-person intake, you're going to want to set the tone for your call. So, you know, that friendly, you know, take some of that fear. People don't like getting their taxes done. So just friendly, light, you know, build that conversation with them. You know how to ask the right questions. The intake form really does that for you. You'll walk through that just like when they're in person. You're going to confirm the date that it's on there. You'll ask about who's living in the household. That's one area that we find that a lot of times our clients think everyone who's in their house should be a dependent, but they're not. You'll ask the questions and you need to fill out the boxes on the right-hand side of the intake as you respond to your answers with that. You'll ask them about their marital status. How many jobs do they have? Again, you're going to be walking through the intake sheet. And just keep in mind, don't agree with everything the client says. Just have that healthy skepticism out there. And again, make this a conversation as you walk through this with them. So now we'll just kind of reinforce some of the things that Jared had spoke about earlier on filing status. On occasion, we'll have clients come to us who may not have been a prior VITA client. They are still legally married, even though they've not lived with their spouse for many years, but there's no children. You may see where their prior year return says that they were single, but that's not the correct filing status. At VITA, we are going to file their return correctly. So in this case, if they don't have children, they would then be filing single. So, you know, what you would do is really just walk them through the chart. Even though they're not sitting in front of you with the 4012, you can still walk them through all those decision points so that they come to the same conclusion as you're coming to. Educate them on all their options. If you have a client that is filing married separate, and many times they haven't seen their spouse in years, we do have that dummy Social Security number, the 111-00-1111. You can use that if the Social Security number of the spouse is not known. Use your decision tree on your 4012. Jared reinforces, I think this year it's a perfect time to make sure you're pulling that out. You're looking at it, as Jared said, when we went through this yesterday, we had to pull our 4012s out just to reinforce that we were making the right decision for that client. While site coordinators, in many cases, unless you're in a production center, will not be sitting there with you. If there's any questions or concerns that you can't resolve with a client over the phone, by all means, get your site coordinator involved. Have that site coordinator reach back out to them and, you know, walk them through so that they can thoroughly understand why that filing status, in this case of married filing separate, needs to be used. Head of household. Head of household, while it is a very advantageous filing status, many times clients don't understand. They assume just because they support the household, they can claim the status without even having dependents. The other thing to keep in mind, you may have an unmarried couple living together with multiple children. There's only one head of household status within a mailing address. So just because they're not married and they have 2 children does not mean you can have 2 head of households for tax filing purposes. So again, just educate the client on what it means to be head of household. Talk through your decision tree within your 4012. Explain to them what a dependent is. And again, any questions you have, reach out to your site coordinator. If you're not in a production center, that site coordinator can call that client and talk to them over the phone also. And again, dependents, we talked about that. Many times people try to claim people who are not eligible. Your decision tree is very clear. And if you ask a client these questions, they too will realize why a dependent can or cannot be claimed on their tax returns. So I think this year, more than any previous year, what do you do if the refund is less than what's expected? It's going to be really important to explain the why. If it's a prior VITA client, that prior year comparison that we've had available in the past is there and gives you very high level differences that you can talk about with the clients. Walk them through the 4012, talk about the appropriate schedules. I think one of the challenges we're going to see this year is with the unemployment, with the $600 of pandemic unemployment people received. If they did not have federal taxes withheld, they may find that they owe money. The other thing is if they were receiving unemployment income this year, didn't work the full year, but in the prior tax year in 2019, they were employed the entire year, their earned income credit is going to be different. At this point, unemployment is not considered income for the earned income tax credit calculation. So again, you'll get more familiar with this as you start working with it. But if you're unable to give a good explanation, make sure you talk to one of your peers, to us, or to your site coordinator to make sure that that client is clear on it. And again, encourage the client. We had some of this happening this summer where a client would sign a return and then they would call us later saying there's no way this could be right. Make sure they understand it. When they signed that 8879, that's giving us permission to file that tax return. So make sure they have those explanations. Okay, so there's a question. If using the dummy Social Security for married filing separate, you can't e-file. Assume that's still the case. To the best of my knowledge, yes, Karen, that is the case. You have to paper file if you're using the dummy Social Security number. So when the client owes money, and again, this could become a situation we have more this year than we have in the past for the same reasons I talked about when they don't get as much of a refund as what they were expecting. The whys are critical. Make sure they understand it. Talk to them, walk them through the 4012 and any of the schedules. Explain what's happening. Sometimes it's a 1099 miscellaneous that they didn't have any withholdings for it and they don't understand what they're liable to pay. Unemployment income is going to be part of this year. I think we will have probably more situations than we expect with this. Site coordinators are always available to talk about this. We're available. And for anyone who hasn't had this conversation before, it is a difficult discussion. The client is probably going to be upset. They may not hear you when you're explaining it to them. So try to be patient. work with your site coordinator. And again, we're here to help support you on this. If you go to your 4012, you go to page K20, it will tell you about balance due returns and what options the client has to pay that. So just some tips for the client. You know, if they're not having enough withheld on their W-2, they can go back and have that increased with their employer. If there's going to be continued unemployment payments that they're receiving in 2021, make sure they're having federal taxes withheld. They have an option to set up a payment plan with the IRS. We provide them with that number. We are not able to set those plans up for them. And then also we can talk to them about quarterly estimated tax payments. That's typically something that we look at with clients who have their own business and they're having Schedule C income. And we're able to print out those estimated tax payment forms for them and give them the envelopes at the same time as they're having their appointments. So again, here's a very, very, very rare situation where you believe the client isn't being truthful. As we said, always have a healthy skepticism about what the client's asking you or telling you. Make sure you're asking questions. Ask follow-up questions. Ask them to clarify. Remember, bottom line, the burden of proof is on that taxpayer. At the end of the day, they are responsible for everything that's on that return. That's when we tell them on the 8879 that they need to own that piece of it. However, if there is a client who you really feel is challenging us and trying to push us to do something that you know is not the right thing to do, it's unlawful, we are able to turn them away. We are able to tell them we will not be able to file that return for them. You can reach out to your site coordinator and they can help you through any of those situations. The question asked, W-4 or W-9? I think that was referring to the withholding pieces. I believe that's the W-4. Oh, Jared, thank you for replying to that. So then that's the end of the slides that I have. So now this is the question and answer piece of it. And Jeff, if you wouldn't mind going through the questions that we have in the chat and direct them to either Jared or I, and we'll be happy to respond to them.
Okay, thanks. So these are questions from Jared's presentation. Is a taxpayer who died in March of 2020 eligible for rebate? This would be the recovery rebate from CARES Act. Jared?
Yep, I can go ahead and handle that, Jeff. So the technical rule from the IRS is if the taxpayer died before receiving the recovery rebate, that rebate should be returned to the IRS. If they died after the rebate was received, whether by direct deposit or by check, that does not need to be returned to the IRS. So if they did get it and they've already passed away and the rebate was received after their death, that money should be returned to the government. And I believe the IRS has a question and answer brochure on how to do that in case we need to continue to send payments back to the government.
Okay, thanks for that. The next question from that same slide, just confirming that you can deduct 100% of your AGI for charitable contribution in 2020.
That is correct. If you decided to give all of your taxable income away to charity, that would be deductible in full.
Okay. And then on the above the line $300 contribution, will we require clients to provide receipts?
So we would view that in the same way that we've done this before with itemized deductions. So technically we would not need receipts to prove the amount. However, it would be up to the taxpayer to substantiate their deductions. In most cases, if the contributions were less than $250, they will probably not get an acknowledgement from the charity. They're not required to have one, but we still recommend, like Michelle had mentioned about kind of the paperwork and documentation, that the taxpayer should hold on to anything they get just in case the IRS does want to come back and question. These amounts are relatively minor, but if they do have a statement from a church or a charity to acknowledge a charitable contribution, then we would have the taxpayer just hold on to those records the same time that they'd hold on to their tax return.
Okay, thanks for that. The next question has to do with claiming qualifying children, and it's specific to confirming that education credits would be another credit you could take with a qualifying child.
Correct, right. So when you have the qualifying child on a return, that also gives you the opportunity to take the education credits with them as well. So that would be another opportunity when you're taking the qualifying child. That would be the education credit would follow that as well.
All right. And then I think this is from your non-custodial slide, just confirming if someone has custody, but the child doesn't spend most of the year with them, who can claim the child?
Okay, so these get to be kind of unique scenarios where you may have situations where a child may be living with another relative or consider temporary absences. So this is where we really consult the chart on who is eligible to take the child. So really what we want to try and make sure is we're looking at the most appropriate area. So for example, if a parent is granted custody, but yet they allow the child to live with their parents for the entire year and have effectively kind of absolved themselves of that responsibility, then the grandparent may actually have an opportunity to claim the child. Now, if the parent wants to come back in and try and claim the child, by definition, the IRS would give the child dependency to the parent, because they would win the tiebreaker rule even if they did not spend more than half the year with the child. So it's a bit of an interesting concept. We usually want to maybe have a few more probing questions about the living situation, where the child normally would be living, and determine whether it be the parent or the grandparent that actually should take that child as a dependent. Now, that doesn't mean that that someone may come in and try and usurp that. And certainly we take a look at the IRS rules for tie breaking to determine where that ultimately should be.
Okay, thanks for that. The next question has to do with the income ceiling for a dependent, confirming that is it any income inclusive of unearned income such as unemployment compensation?
And so I guess trying to get a little clarity on that one, Jeff. So looking for the purposes of the, are we looking at the dependency exemption in that context?
Yes, sir.
Okay, so what we're looking at here, so the nice part about the 4012, there's some very good information on the 4012 on what we mean exactly by support. So if we're looking at support for a child, we would go to the C3, your 4012. And the footnote 3 would go through and helping to determine what support actually means. And there's actually in your 4012 a whole worksheet on determining support. So that would be where is the money being spent, where is the money coming from, and determining whether or not the child or someone else has provided more than 50% of their support. Same type of issue we run into when we're talking about the gross income for the qualifying relative. And usually we have some questions about that $4,300. What does that really mean? And if you take a look at your C4 in your 4012, footnote number 3 will talk about what the 4,300 means. And that would actually take out a couple things like Social Security benefits, if there's any income earned through a qualifying residential program or shop for incapacitated people, that would also be excluded as well.
Okay, and unemployment compensation itself, particularly this year with the CARES bonus, the weekly bonus?
So the unemployment would actually be considered as part of gross income. So that is not excluded at this point. So that would be included in gross income. Okay,
thanks for that. The question following that had to do with SSD, which you covered, and then the subsequent question had to do with Social Security income in general. So I think we're good there.
Sure, and Jeff, that's a great question, because this sometimes comes up a bit, particularly with individuals that were claiming the child when they're totally and permanently disabled. Particularly, what do the different state programs, or what happens if they're receiving income from an assistance program? And the 4012 does a great job of going through and kind of delineating what each of these mean. Generally, any support from the state will not be considered income for these purposes. So that actually, fortunately, the 4012 does a pretty good job of clearing that up for a lot of those questions as they come in.
Okay, thanks for that. And then moving on to your slides related to status, marriage filing status. How do you prove marriage versus civil union or agreement?
These are always kind of the fun ones we talk about, is going back to Michelle's point about generally taking taxpayers at their word of whether or not they're married, whether or not they have a relationship that has been recognized as a marriage. So we do not require that they bring in their wedding album or the cake topper, or we don't need to watch a wedding video to prove that they are actually married. If they come in and tell us that they're married, we generally take them at their word for that. So we don't actually need any proof that they are married. Usually most of the other kind of unique arrangements like the common law marriage and civil unions are from states outside of Pennsylvania. But if they come in and they tell us that they are married, we generally will go ahead and take that as proof without a whole lot of additional detail, unless we feel that they're not being truthful.
All right. Moving on to head of household, the qualifying child check decision tree for head of household, is that the same as the decision tree for a dependent?
So the head of household dependents are a bit different from those that we use for the qualifying child or qualifying relative. So you just want to watch that a little bit as you go through the same rules. So you can't always use the same definition for both areas. And it is kind of confusing because the IRS uses the same terminology. They keep calling it qualifying child, but they change their rules on you as they go through the various components. So for example, a qualifying child could work as a dependent, but if that qualifying child is your grandchild, that does not provide you the opportunity to be considered unmarried for head of household. In addition, there are a couple slight changes in the head of household definition for a qualifying child and qualifying relative. Like I said, the qualifying relative test could mean someone who's been in your household all year, but that same person being in your household all year does not give you head of household status. So you cannot get head of household status by having a significant other living in your house for an entire year.
All right, thanks for that. The follow-up on the head of household and qualifying widow status. If the spouse died more than 2 years ago and the surviving spouse did not remarry, would that person now be single? And I think this is being asked in the context if there are children still living at home.
Right. So if a spouse died in the current year and they had qualifying children, they would still be married filing jointly for the current year. For the next 2 years, as long as they still had qualifying children and they met the other tests, they could be the qualifying widow or widower. But then after that second year, then they would revert back to a single classification, which could still be head of household if they meet the other classifications at that point in time.
All right. Can you clarify when we do the substantial presence test? Would we have to do that if they have a green card?
If they have a green card, the green card test actually comes first. So the area that we take a look at would be your tab L within your 4012, which walks through a little bit of the kind of special rules for resident or non-resident alien. So if they have a green card, they immediately are treated like a U.S. citizen for tax purposes. If they do not have a green card, that's when we'd go through the substantial presence test.
Okay. Is filing worldwide income similar to filing U.S. income?
Yeah, so the rule that we have here is if you're a U.S. citizen and you file a U.S. income tax return, you would need to report income from anywhere received. So if you're filing a U.S. Form 1040, you are actually obligated to report all of your income from all sources. So that would include if you're receiving dividends from a company from Germany, if you had Canadian income, if you had a job that took you overseas, you need to file your U.S. income tax return based on worldwide income. So if you are considered a U.S. resident, if you have a green card, you are also required to file based on all your income worldwide. So it's actually the same definition you'd have. You're treated as if you would be a U.S. citizen.
Got it. All right. Next question. Do individuals who don't have a green card not need to file taxes?
No, technically, if you have U.S.-based income, you do need to file income taxes. So if you don't have a green card, we could take a look at the substantial presence test and determine if you would be considered a U.S. resident alien for tax purposes. But even if you would be considered a non-resident, so even if you don't meet the definition, you would still be subject to taxes based on your U.S. income. And you would most likely need to file a Form 1040-NR. And unfortunately for VITA, we do not handle those. I think we do have some recommendations of where people can go if they need a Form 1040-NR. Usually those situations may arise when you have a college student who's on campus and they have a job either with the college or university, or they may have a part-time job. Oftentimes you may want to check the college may have a service that they provide for the foreign students to go ahead and file the 1040-NRs with them. If not, we may have to recommend them to an outside tax provider, but someone we feel would be competent to be able to handle a 1040-NR issue because they are a little bit more complex.
All right. This goes back to your slide on changes for 2020.
Yep.
I think you may have clarified this. What is the recovery rebate?
Sure. So the recovery rebate is the tax credit that was issued here, the amount of money, the $1,200 stimulus payment that most people may have received earlier in the year. And we'll provide a little bit more information on the recovery rebate as we talk about income and credits throughout the process. But it's the same terminology we've been using here for the economic recovery payments. Got
it. Next question. If the client is a foreign student studying in the U.S., student visa, no green card, with an ITIN, and has been here for 2 or more years, do we file a 1040-NR or a 1040?
Generally, in those cases, we take a look at the student visa, and it would most likely probably indicate that they would be a 1040-NR. So we would not need to go through the substantial presence test in that case. Most likely, they would probably be filing a 1040-NR if it's considered a temporary stay here in the U.S.
Okay. Next question. In 2021, do I understand you don't have to take a distribution? They may be asking relative to tax year 2020.
Right. So for 2020, the RMDs have been suspended. So you do not need to take a distribution from a retirement plan if you were required to take one. So for the year 2020, you do not need to take a RMD.
Okay. Is the $300 above the line charitable contribution doubled for married filing jointly?
That would only be for, it's $300 irrespective of filing status.
All right. Are the tests for resident alien either or? Yeah, so again, with those, what we'd be looking at is taking a look at your L1 on your 4012. Usually what we're looking at there for the resident alien is you would either meet the test for resident alien and file a U.S. return, or you would be considered a non-resident. So as you go through the chart there, you would either be filing a full 1040 as a resident alien, or you would be considered a non-resident alien and file a 1040-NR just based on your U.S. sourced income. Okay. Sorry, just scrolling down to the bottom here. Let's see. What forms will tell us the amount of worldwide income?
All right. So one of the things that we would take a look at for worldwide income is we're essentially pulling any of the forms that the taxpayer would provide for us. If a U.S.-based taxpayer has foreign sourced income, the majority of times we're going to see that is foreign dividends, which if you get that from a brokerage statement, they're already going to include that in your Form 1099 DIV. But we will talk about foreign taxes as a credit, so we may have the opportunity to go ahead and take those. Other things would be if they provide the documentation to us and say that they had a maybe a pension from a foreign country or had an overseas assignment and were working for a non-US based employer. So they basically would have to tell us the worldwide income. These get a little bit more complex because especially if these forms are delineated in foreign currency, we have to go back and translate them back to US dollars and figure out the correct methodology. We probably refer them to Tim, who has a lot of experience with Canadians and reporting income on 1040s. But yeah, we'd probably take a little bit more time to ensure that we have all the documentation from the taxpayer.
Okay, thanks for that. And then last question in the chat, and encouraging folks, this is your last chance to ask questions for this training session. The individual wanted some additional clarity on what the rebate was, but I think it just might be timing. Jared, I think you've already explained it, that it's the CARES rebate. Right.
Yeah. So the technical term, and we've been kind of calling it a rebate here, is the economic impact payment. So the EIP. And if you take a look at our materials, they're going to be talking about the economic impact payment. So what we take a look at here is the characteristics, whether or not they received one, whether they would be eligible for one if they did not get the full amount. So the main issues we take a look at with that economic impact payment would be if they received it and they, based on their 18 or 19 information, and they are not eligible in 20, they get to keep it. If they died before the impact payment was received, they need to pay it back. If they died after it was received, they do not need to pay it back. So what we're probably going to look at for the majority of issues for the 2020 filing season is to determine how much, if any, did the taxpayer receive in that EIP, and would they be eligible for any additional amounts for the current year. So we'll go through a little bit more information, and we're still waiting on hopefully a lookup version from the government to determine how much they received, because I've heard not everyone has kept their letter signed by, well, we don't know if still current or former President Trump, that indicated how much they had received in their economic payment.
All right, got it. Thanks, Jared. And Michelle, there were just a couple of questions about training material. Someone was asking where they would pick up the training booklet and when.
Okay, so the 4012s and the certification test booklets are supposed to be shipped to us sometime mid-November. So we do not have them yet, but we expect them in the next week or two. As soon as we receive them, we will send out an email to everyone letting you know that we have them and where and during what hours you'll be able to pick them up.
Okay, and then a question about the 4012 itself, if we'll be making that available to the team.
Yes, we will make the 4012s available. I've sent links out to everyone. I can resend them out with the next email so that you have them electronically, but we will let you know as soon as we receive them so that you can come pick them up. And as I had said earlier, the practice lab, so if you're working on your test through the electronic version, the file, the practice lab is supposed to be open with 2020 tax data for you on the 10th of November, which is next Tuesday. So again, I will send out an email once we know that that is up and available for federal. The state pieces and local will not be in the practice lab until January.
Okay, thanks for that. And then Jared, just tossing a couple last minute questions back to you. Will small business owners who claim PPP or other funds have to report these amounts as income?
Yeah, good question on those. Most of the PPP funds, and this, I would imagine the context within VITA would be the individuals who are self-employed who applied for the PPP loans, generally should have those forgiven. So a small business owner who does not have any employees, which is kind of where we'd see that typically in VITA. It could be someone who, again, is an Uber or Lyft driver, or maybe had some babysitting or other money, childcare. Typically, the PPP funds that they receive are a non-taxable item. So the fortunate part we have in VITA is we have a whole lot less issues to deal with because these amounts, as long as you're going through the forgiveness process, are treated as a loan. So these would never be considered income. Either they have to be repaid as a loan, which means it's not taxable, or they're going to be forgiven. And if they're forgiven under the PPP program, they would be considered a non-taxable item of income. So they would not be taxed.
Okay. Then last question I have is, what is the default status if the taxpayer has been long separated from a spouse and it's unclear whether or not that spouse is still alive? In other words, they might be married, they're not divorced, but the taxpayer just does not know the status of that estranged spouse.
All right, I think, Michelle, I'll let you handle that one from a VITA perspective, how we've handled that in the past.
So from a VITA standpoint, let me get a position. I truly want to reach out to my spec partner to find out the answer to that. I have never had a situation where someone's been separated that many years and doesn't have an idea if they're not alive. I would assume if we don't know for sure that they are not deceased, that they would file married filing separately. But let me follow up with Joe and get an answer for you on that.
Okay, thanks for that. And that was all the questions we had. Thank you all.
Okay, so just to wrap things up, if you haven't completed your survey, please do that. That's helpful for us to figure out how many sites we'll be able to have open this year. Tomorrow, we will send out the recording for this. So if you've missed something, you want to go back and reinforce certain areas, that will be available to you. Our next tax law session will be next Thursday, November the 12th. It'll start at 5:30 and we'll be covering income. Remember, this year, since we're requiring advanced certifications, we will pick all income topics up within that section. Just like I did this week, I will send out an email that will have the presentation deck available for you so that if you want to look at it in advance or print it out for yourself, you'll have that also. Other than that, I have nothing else for tonight. Thank you all for joining us. I hope you have a great rest of the week, and we'll talk to you next Thursday.